For decades, financial advisors told families the same thing. Your pension is one of the few things you can pass on completely free of inheritance tax. That advice is about to expire. I'm Angela Rose, and today I'm walking you through the new rules, what HMRC has confirmed, and what it means if you're planning to leave your pension to your family. Hi everyone, welcome back. I'm Angela Rose, and this channel exists to take confusing financial and government news and turn it into something clear and useful for your real life. Today's topic is a big one. Unused pension funds are being brought within the scope of inheritance tax, starting the 6th of April, 2027. This isn't a rumor or an early proposal anymore. The legislation has passed, and HMRC has been issuing guidance to pension schemes and personal representatives to prepare for it. By the end of this video, you'll understand exactly what's changing, why HMRC is involved, who's likely to be affected, and what steps are worth considering now. Let's get into it. Let's start with what's actually been confirmed, because it's important to separate settled fact from speculation. This change was first announced by the Chancellor in the autumn budget of 2024. Since then, it's gone through a formal consultation process with the pensions industry, and the legislation was finalized as part of the Finance Act 2026, which received royal assent in March of this year. The rules take effect for deaths occurring on or after the 6th of April, 2027. HMRC's role here is significant. Personal representatives, meaning the executors responsible for handling someone's estate, will be the ones required to report and pay any inheritance tax owed on unused pension funds. HMRC has also confirmed that pension scheme administrators will be required to provide information about the value of any unused pension funds or death benefits within 4 weeks of being notified of a death, so that this can be factored into the overall estate calculation. Here's the core change in plain terms. Right now, most defined contribution pensions, the type where you've built up a personal pot over your working life, pass to your chosen beneficiaries outside of your estate for inheritance tax purposes. That's meant pension wealth has often escaped the 40% tax that applies to estates above the tax-free threshold. From April 2027, that protection is largely removed. Most unused pension funds and pension death benefits will count toward the value of your estate. There are exceptions worth knowing. Payments to a surviving spouse or civil partner remain exempt, as do payments to a registered charity, and death in service benefits from workplace schemes. But payments to children, grandchildren, or other family beneficiaries generally will not be exempt going forward. So why is HMRC pursuing this now? The government's stated aim has been to close what officials describe as a gap that allowed pensions to function primarily as an inheritance planning tool, rather than serving their original purpose of funding someone's own retirement income. According to HMRC's own published estimates, around 10,500 additional estates are expected to become liable for inheritance tax in the first year alone because of this change, with an estimated 38,500 more estates paying a higher bill than they would have under the old rules. It's also worth understanding how this interacts with tax that already exists. If someone dies after age 75, their beneficiaries already pay income tax on pension withdrawals at their own personal tax rate. From April 2027, that same pension money could also count toward inheritance tax before it's even withdrawn. The government has said an income tax deduction will apply, so the two taxes aren't simply stacked on top of each other in full. But based on the information currently available, this adjustment won't eliminate the added tax burden entirely for many families. It reduces it rather than removing it. I want to be clear about something here because headlines can make this sound more alarming than it needs to be. This isn't a tax on your pension while you're alive, and it isn't a tax that applies to every family. It only becomes relevant for the portion of pension wealth left unused at death, and only if your total estate, pension included, is likely to exceed the inheritance tax threshold, which currently sits at £325,000, plus an additional residence allowance in many cases. Let's make this practical. This matters most to people with meaningful pension savings who also plan to leave some or all of that pension unused to family members, particularly if their overall estate, property, savings, investments, and pension combined is likely to sit near or above the inheritance tax threshold. Here's my honest personal recommendation, not an official directive. First, review your total estate value now, pension included, rather than waiting until closer to 2027. A lot of people have simply never had to think about inheritance tax on their pension before, so this is genuinely new territory for many families. Second, revisit your will and any expression of wish forms tied to your pension. These documents guide who receives what, and it's worth making sure they still reflect your current wishes and circumstances. Third, if you believe your estate is likely to be affected, speak with a regulated financial advisor or estate planning solicitor well before April 2027. There may be legitimate planning options available to you, but this is very much a situation where personalized advice matters because every estate is structured differently. And finally, HMRC has indicated that further detailed guidance is still being developed, with more expected throughout 2026. Some of the finer operational details, especially around exactly how reporting and payment will work day to day, are still being finalized. I'll continue covering updates here as that guidance becomes available. Let me step outside reporter mode for a moment and speak with you honestly. In my opinion, the word warning gets thrown around a lot in headlines about this topic, and I think it's worth pausing on that. This isn't a sudden penalty being sprung on families with no notice. It's a confirmed law change with a clear future start date, giving people real time to plan ahead. That said, I do think the real risk here is awareness, not the tax rate itself. Too many people still assume their pension sits completely outside their estate, and that assumption simply won't hold after April 2027. I'll also say, I understand the government's reasoning about closing what's been called a pension as inheritance loophole. Whether you agree with that policy is genuinely a matter of personal opinion, and I'd encourage you to form your own view. But regardless of where you land on it, the practical takeaway is the same. If this could affect your family, early planning matters far more than late worrying. Quick recap before we wrap up. From the 6th of April, 2027, most unused pension funds and pension death benefits will fall within the scope of inheritance tax under the Finance Act 2026. HMRC will require personal representatives to report and pay any tax due, with pension scheme administrators providing valuation information within 4 weeks of a death being reported. Exemptions remain for spouses, civil partners, registered charities, and death in service benefits, but payments to children and other beneficiaries generally won't be exempt. If you have meaningful pension savings you plan to leave to family, this is worth reviewing now, well ahead of the 2027 start date. That's today's update. I hope this gave you clear, level-headed information on a change that's going to matter to a lot of families in the years ahead. As always, for decisions specific to your own estate and finances, please speak with a regulated financial advisor or solicitor, and keep an eye on official HMRC guidance as it continues to be published. If this video helped you, please hit that like button. It genuinely helps this information reach more people while there's still time to plan. Subscribe and turn on notifications too, since more HMRC guidance is expected as we move closer to 2027. Let me know in the comments, is this the first you're hearing about this change? I read every comment, so let's talk about it down there. Thank you so much for watching. I'm Angela Rose, and I'll see you in the next one.